Now on Overnights,
I believe in reason and common sense.
Leith Van Onselen from Macro Business with a treasury of common sense.
Common sense never goes out of style.
Leith, good to have you back, mate. So you've got the key inflation data, you've got some Senate estimate stuff. What have you got for us?
Obviously, Australian mortgage holders are doing it tough. So if you're carrying a mortgage, we've seen a lot of interest rate hikes this year. We've seen 3 interest rate hikes, and that was on top of the series of interest rate hikes we received over previous years. And as a result, Phil, Australia actually has one of the highest mortgage rates in the advanced world at the moment. So Australian mortgage holders are paying more interest and high interest rates than just about anywhere else on the planet at the moment, which is why Australians who are carrying a lot of mortgage debt are obviously doing it tough. Now, the good news was that the Australian Bureau of Statistics on Wednesday released the Consumer Price Index data for the June quarter, and economists were worried that this might actually come in a little bit hot. And the reason why they're worried is that last week we actually got the unemployment data from the Australian Bureau of Statistics for June as well, and that actually was a very strong print. And the Reserve Bank of Australia, they've got basically a dual mandate. So their mandate is to obviously try and keep prices between inflation between 2 and 3%, which is their target, their official target. Their other target is to try and maintain full employment. And with the strong labour force released last week, the risk was that a strong inflation print on Wednesday would prompt the Reserve Bank of Australia to actually hike interest rates, and that was obviously a concern. The good news coming out of it was that the inflation data actually came in softer than expected. So the Reserve Bank of Australia was expecting an annual inflation rate for the June quarter to come in at 3.7%, and the financial markets are also expecting it to come in at 3.7%. I'm talking about the trim mean inflation here. So that's basically the inflation rate you get once you shave out the volatile items. Now, the trim mean inflation is what the Reserve Bank of Australia actually looks at. And the good news is that it came in a bit softer. And as a result of coming in softer, it actually reduces the likelihood that the Reserve Bank of Australia is going to hike at its meeting next month, which is obviously good news. Now, there was concern amongst financial markets economists that the Reserve Bank of Australia would hike, which would obviously be a hammer blow to a mortgage holder. Now, there was some other data that came out here which was actually very favourable. So we got 2 consecutive quarters, so I'm talking about the March quarter and the December quarter, whereby the pace of inflation actually slowed. So if you just look at the last 2 quarters and you annualise that rate, the inflation rate actually fell to 3.2%. Now, the reason why the annual rate over the year was 3.6% was because most of the inflation over the year was front-loaded in the first 2 quarters. So the Reserve Bank of Australia will probably look at that and say, hey, in the March quarter and the June quarter, we actually got a slowing of inflation. Now, it's still tracking above what the Reserve Bank of Australia's target is, which is to keep it between 2 and 3%. But the fact that we got this slowing in the most recent quarters would give the Reserve Bank of Australia, a bit of comfort that inflation isn't tracking as high as they were concerned, as they were worried that it was, and indeed as they forecasted. Now, what this basically means is that we're almost certain not to get an interest rate hike in next month, which is obviously great news. And it also suggests that the Reserve Bank will only hike interest rates in September or later if the data tells it that it needs to hike interest rates. So what I basically mean by that is if the unemployment rate, continues to track at its current low level or falls, or if we get abnormally strong job growth, or if upcoming inflation releases next month, the following month, etc., end up re-accelerating. So the base case at the moment is that when the Reserve Bank of Australia delivers its next meeting on monetary policy, which is next month, that it's going to hold rates, but it'll probably do what's called a hawkish hold, in that it'll hold rates, but it'll threaten further rate hikes if the data warrants. And that way, by basically being hawkish on interest rates, sort of saying, look, we've kept them on hold, but we're still keeping a watchful eye, and there is the risk that we'll still hike rates, et cetera, sort of maintaining that kind of language. It basically signals to Australians to not go out there and think that rate cuts are coming, and that to go out and spend. So yes, good news. If you're a mortgage holder in Australia, interest rates are unlikely to get hiked next month, which is obviously great news if you're a mortgage holder. whether or not the RBA is going to hike in the future, it'll end up looking at the data. It'll follow the data. If we get inflation rising or the unemployment rate falling, that'll pressure the RBA to hike. But so far, so good.
Where can we find the info on this one?
You can find me at macrobusiness.com.au.